AI is changing the game, but not the way most people think. As the herd chases AI stocks, the larger macro current continues shifting toward bonds and deflation. Like Indiana Jones said, they're digging in the wrong place. Hello, my name is Daniel Young, and this is Adapted Perspective. Every week, we separate currents from noise and opportunity from fear using an income focused strategy and closed end funds. This isn't polished, it isn't scripted, and it's definitely not herd thinking. We don't chase headlines, we navigate the markets. Now, let me be clear, I'm not a financial advisor or a fiduciary. I'm an income hunter, a strategist who filters the noise, follows the data, and targets real cash flow, even when that means taking a different course. So let's step into this week's waters and see what's actually moving. As I prepared this video, this was a harder week to write about because the market itself didn't change much. The headlines changed, the narratives shifted, the experts recycled opinions, but the underlying currents barely moved. And honestly, that matters more than the noise. Most of the market commentary this week centered on AI and equities again. The big seven, growth stocks, momentum trades, same story, different headlines. And while the herd continues chasing the shiny AI object, they're missing the bigger macro shift happening underneath. Because the real story isn't AI stocks, it's AI's impact on bonds. Here's where the market actually is. Right now, we're sailing the trough between higher rates and lower rates. The market hasn't fully transitioned yet, but the direction of the current is becoming clearer. GDP continues to grow. Employment remains steady. Ghost jobs continue to disappear, while more Americans move into real full time work. Inflation continues to hover in the 2.5 to 2.6 range. Energy production keeps increasing, and AI continues lowering cost and forcing competition. That combination matters because AI is structurally deflationary. It lowers labor cost, it improves efficiency, it reduces production friction. And when paired with expanding energy production and growing economy, it creates downward pressure on inflation over time. That's why bonds continue leading the financial currents. Not because bonds are exciting or because the herd suddenly loves fixed income, but because lower rate environments historically favor bonds and select bond proxies. Whether people want to hear it or not, the market continues to point in the same direction. Okay, if the economy is doing so well, what's with the gas price confusion? Some people look at gas prices and assume inflation is surging again. But this is where separating waves from currents matters. Yes, gas prices spiked temporarily, but that spike was largely sentiment driven. The herd hears war, OPEC, Iran, shipping disruption, and they immediately assume the US economy is under pressure. But the United States is energy independent. Domestic production continues to increase. New refineries are coming online along the Gulf Coast. And global instability is actually strengthening America's position as an energy supplier. That means the spike wasn't really about collapsing supply, it was fear pricing. That's noise, not a change in the underlying current. And when you understand that distinction, you stop reacting emotionally to every headline cycle. So, why does the herd keep missing it? The herd wants obvious stories. AI is obvious. Stocks are exciting. Price spikes are easy to understand. Bonds also feel boring, but boring is often where the real positioning happens. Most herd investors chase reflections on the surface because reflections are easy to see. You must search for currents. And if you find one, currents require patience, interpretation, and thinking beyond this week's headlines. And that's why some people continue to dig in the wrong place. AI isn't replacing the bond market or the bond current, it's rewiring it and increasing the flow. And that's why this week's closed end fund snapshot still centers primarily around bonds and select bond proxies. But despite the noise, the currents haven't changed. So let's get into the CEF snapshot or the closed end fund snapshot. Let me share my screen. There we go. So this is the final seven. Yeah, final seven. As I, gosh, this week was challenging. I went through and completely updated every fund on price, dividend, checked the yields, went through the net asset values and reordered the targets, plus read it, we'll say updated the color system based on these parameters. And in filtering the list down to this seven, it still centers heavily on bonds and bonds proxies. There's one exception, which is BRW, which is it started as a bond fund, but it's much less a bond fund. It's just a general overall high income vehicle. Uh, so of the seven, I mean, sure, we can weed out BRW as an overall income vehicle not fitting the bond narrative. But quite honestly, any of the seven are top for the week. So based on targets, triple asterisk is uh, more notable than the rest. I guess most notable. Two would be a dollar cost average move on my portfolio. So maybe it's not on yours. And then monthly payer, I'm shooting for a 9% or greater yield unless there's a good reason to include a lower number or a lower fund. So on IGR, it doesn't completely fit the narrative in the sense that it's not a triple asterisk. But on my end of things, it would still be a dollar cost average move. It's closer, I think, to my overall average. Overall average, I want to say, is 5.44. So we're still 60 cents off of that, but it's not as great of a deal as it used to be. RFI pays a consistent 8 cent dividend that is just, it's insane how steady it is. It's just amazingly stable. And I came across this review this week. Really, this is my review. I've been uh, creating contact cards or context cards for every fund on the list, which is slow go. But there's this take for RFI and its comparison to its sister fund. Um, if we look as we look at bonds and bonds proxies, bonds themselves, I see still being the primary current. Bonds proxies, especially real estate, would be a tie for second current, secondary or even tertiary with end-to-end energy and technology beyond the big guys. But lower interest rates will impact bonds for sure. They will also filter down and impact real estate. So in that regard, I'm okay with leaving RFI on the list. I mean, price wise, it hovers around our average buy-in price, but it also doesn't really go on sale. Um, but really, the four pack in the middle is the highlight for bonds. PHK with its legacy portfolio, PTY with its U.S. and international markets, PDO is currently the darling fund. It's the fund everybody wants. And then DLY really is just a overall product specialist. Um, Despite those three sharing a name, they really do different things. But the focus really would be bonds. The question would be if you want just an overall, gosh, it's like an income steam engine. It just rolls. Or if you want real estate through RFI. But honestly, that's it. That's the top six. I wish I could. No, I really don't. There's part of me that wishes the narrative would change to where I really do just pick the same funds every week, but it's not me just picking the funds. It's picking the funds based on the current. And it's picking the best funds that I would invest in based on the current. It's really about the same thing. We bought this list in the cash brokerage and in the Roth. And yes, I would love to see AWF come back, but looking at their dividend, we go to the master. AWF's dividend is consistently below 9, but it is that overseas bond share. With that being said, PDO and or PTY and PDO are both US and international bond funds. So as much as I have hope, as much as I have continued to house AWF on my wish list of funds, currently I'm okay passing it by because yes, it pays a consistent dividend. It pays that 7.5 consistent dividend. That's great. But PTY also pays like a 4% greater yield and consistently does it. Um, yeah, so I'm okay passing on AWF. But these are the top six. So it really just depends on your take of the market. Bonds would be my preference. RFI, it is a close second, and then BRW would sit with RFI. I love the portfolio in the sense that it's a great dollar cost average move for me, um, with the private credit market squeeze and what sounds like overblown fears in the private credit market. BRW has been buying private credit, um, attempting to enhance their portfolios. The lag on price or the slightly wider discount I've heard or I've read is that following the rights offering and then following rumors of a merger between BRW and Saba, both funds, um, there's just uncertainty among the funds. It's not a lack of confidence. It's just people want more data than sentiment, or at least most people do. So if we're rating it simply on that top bond current, it's the four in the middle. If you're willing to consider something else, it's really a top six. Um, and if it's me and I'm investing and I'm not buying tomorrow. Currently, I'm just trying to survive the weeks. There's 2 weeks until our summer break. Um, I should be buying this week, but I don't want to say more important stuff to do, but at the same time, I've got a lot of other stuff to resolve until I come back to another investment. Part of that, second, I get Iran. That doesn't have me phased. I'm curious how the next inflation data report comes out, and I'm curious uh, about the Federal Reserve transition. I'm hopeful that our new chair cuts rates. I'm hopeful that our existing board isn't cutting rates because they don't want to make Powell look bad on the way out. But I'm curious how the transition of power will go with that group and its future bearing on interest rates. I still believe we're moving into a deflationary market and we'll see lower rates this year, but we'll see how that unfolds. So that's all I have for the week. It's the six set. Uh, take it for what you want. But if I was investing tomorrow, that's what I would be targeting. So I'll leave you with these final thoughts. The news cycle changed this week. The financial currents did not. And that's why we don't chase headlines. Or expert opinions for that matter. We're not looking for yesterday's reflections. We're positioning ourselves in the active financial currents moving into tomorrow's market. Because when you're in the right current, the market does the heavy lifting for you and it pays you while it pulls you forward. So that's it for this week. I'll see you next Sunday. I wish you a successful week in whatever you have going on. So have a great week, and I will see you all next weekend. Bye bye.